So again, I welcome you all in this third part of this ratio analysis series. In this particular video, we are going to discuss about activity ratios. Previously, in the first part, we have discussed what is ratio analysis, what is its utility, and then we have discussed some ratios like current ratio and quick ratio. Whereas in the second part, we have discussed about the long-term ratios that are debt equity ratio, proprietary ratio, etc. So in this third part, we are going to discuss about activity ratios. So let us start. So activity ratios. So these ratios are also called as efficiency ratio or asset utilization ratio, or we also known as these ratios as turnover ratios. Okay, so this ratio shows the relationship between sales and various asset of a firm. Okay, sales and various asset of a firm. The various ratios under this group are inventory or stock turnover ratio. As we know, inventory and stock are the same thing. So inventory or stock turnover ratio, then data turnover ratio and average collection period. So along with the data turnover ratio, we also calculate the average collection period, whereas the third one is asset turnover ratio and the fourth one is creditor turnover ratio. And along with creditor turnover ratio, we also calculate the average credit period. Okay, so coming up, let us see one by one. And the first one is inventory or stock turnover ratio. Correct. So this ratio indicates the number of times inventory is replaced during the year. Okay, it measures the relationship between cost of goods sold and the inventory level. There are two approaches for calculating this ratio. The first approach says that inventory turnover ratio is equals to cost of goods sold divided by average stock. And we know average stock is nothing but opening stock plus closing stock divided by 2. And the second approach says that sales divided by closing inventory. So basically, we prefer the first approach, that is inventory turnover ratio equals to cost of goods sold plus average stock. This is the most widely used formula for calculating the inventory turnover ratio. And the main thing here is that it represents the number of time inventory is replaced during the year. That means how many times a person or a company need to replace its inventory in a year. So that's why we are dealing with the cost of goods sold, that is COGS. And for getting our COGS, how much times we need our inventories to be replaced in a year. So this ratio particularly deals about the stock turnover ratio. Okay, and coming up, a stock turnover ratio, a firm should have neither too high nor too low turnover ratio. Okay, so too high a ratio may indicate very low level of inventory and a danger of being out of stock and incurring high stock out of cost. Okay, on the contrary, too low cost is indicatively of excessive inventory entailing the excessive carrying cost. That means if we are we are dealing with too low ratio, that means the company is uh, dealing with too much of carrying cost, whereas the too high ratio indicates that the company might face some out of stock situation. If the ratio is too high, then it indicates that the company is placing the order very less times. That means they might have in future they might have facing the out of stock situation. But if the ratio is too low, that means they are giving the order too many times. That means they may have facing the extra carrying cost. I hope it is clear. Coming, so now the next one is debtor turnover ratio, and along with that we will also calculate the average collection period. So this ratio is a test of liquidity of debtors of a firm. It shows the relationship between credit sales and debtor. So there is a one basic concept. I hope you guys all aware of that there are two types of sales. The first one is cash sales and the second one is credit sales. So in the cash sale situation, we sell something and directly the cash comes to us. But in the second situation, credit sales, we sell something on credit basis and then that thing particularly becomes our debtor. Let's say a person has sold something to a person or a farm or company, then they become their debtors, and then after debtors, then they becomes the bills receivable, and then after from the bills receivable we collect the money in cash. Okay, so this is the procedure. But let's say suppose the some of your debtor is not paying, then it becomes your bad debt. Okay, so this debtor turnover ratio particularly depends upon our credit sale, not upon our total sales or cash sales, but it totally depends upon credit sales, because the debtor is the debtor is generated from our credit sale. Okay, I hope this is clear. So the debtor turnover ratio formula is credit sale divided by average debtor and bills receivable. So what is average debtor and bills receivable? This is together known as trade receivables. Okay, so debtor and bills receivable are together known as trade receivables. Okay, so average trade receivable is opening receivables plus closing receivables divided by 2. Okay, just like average stock. Okay, so we will just divide the credit sales by average debtor and bills receivable, while in the case of average collection period we use in months and days, or sometimes we also use in weeks. So what we do, we can simply use the, let's say, 12 months or 365 days or 52 weeks divided by our data turnover ratio. Okay, I hope it is clear. After getting your data turnover ratio, what you need to do to get the average collection period, you will just write the month, days or week, and then you will divide that with the data turnover ratio. Now there's one more shortcut here. Now what we will do, we will simply reverse this formula. So we will use average data and bills payable in the numerator, and while we will use credit sales in the denominator. Okay, and then we will multiply this with 12 months or 365 days. Okay, so for getting the average collection period, or we can also use 52 weeks. Okay, I hope this is clear. So there are two techniques to get the average collection period. The first one is we can we have to first calculate the data turnover ratio by dividing the credit sales with average debtor and bills receivable. Then for average collection period, what we need to do is month or dates, then debtor turnover ratio. While the second technique is, what we will do is average collection period. So simply we will reverse this formula. So average debtors and bills receivable will be coming in numerator, while the credit sale will come in denominator, and then we will multiply this with this 12 months or 365 days or 52 weeks to get the average collection period. Now what is average collection period? That means the data that are for your company or firm, that in how much duration they are paying you back. That means if a company or a firm has a higher average collection period, that means they need more working capital because their capital is engaged, or it has been captured by the debtors, right? So for the lesser the average collection period, the better it is for the companies. I hope it is clear now. So let us go to the next slide. Okay, just a second. So these ratios are indicative of efficiency of the trade credit management. A higher turnover ratio and the shorter collection period indicates the prompt payment by the debtor. On the other contrary, the lower turnover ratio and a longer collection period indicate the delay in payment. So in general, a higher debtor turnover ratio and a shorter collection period is preferable. That means if your debtor turnover ratio is higher, so your average collection period will be lower. So it is preferable by the companies, while on the other hand, if your debtor turnover ratio would be lower, so your debtor collection period, average collection period will be higher. So that is not preferable for the companies. They prefer higher debtor turnover ratio while shorter collection period of time. That is preferable for the company, as they will need less amount of working capital for financing their current asset. I hope it is clear. Coming up next slide. So the next one is creditor turnover ratio and average collection period. Okay, so this ratio shows the speed with which the payments are made to the suppliers for purchase made from them. It shows the relationship between credit purchase and average collection, average creditors. The previous one was debtor turnover ratio and average collection time, while this ratio shows the creditor turnover ratio and average credit period. It is just opposite of debtor turnover ratio. In the previous case, we dealt with credit sales, while in this creditor turnover ratio, we will dealing with credit purchases. Okay, so it is just opposite of that. So creditor turnover ratio will be equals to credit purchase divided by average creditors and bills payable, that is togetherly known as trade payables. Okay, so we will, in the previous case we are just using the credit sales, while in this particular case we will using credit purchase. And in the previous case we are using the average debtors and bills receivable, while in this case we are using the average creditors and bills payable. Okay, and for the average collection period, it is just like the previous one. We will simply use the months or days in a year, and then we will divide this with the creditor turnover ratio. Okay, and also we can use the second option, that is we will use this average creditor and bills payable in the numerator. Okay, and we can divide this with this credit purchase and also multiply this with 12 months or 365 days to get our average credit period. Okay, so what does it credit period means? It simply means that in how much time you are paying back to your supplier or your creditor. It simply means that. So if we are paying in delay, that means we need less amount of working capital. And if we are promptly paying, then there are so many benefits of it, but we need a higher amount of working capital to get the ratio effective. Okay, so let us see the next slide. So, higher creditor turnover ratio and short credit period signifies that the creditor are being paid promptly, and it enhances the credit worthiness of the firm. That means if your credit turnover ratio is higher and you have a shorter average credit period, that means your credit worthiness is better. That means if in near future you will ask your supplier to give the goods on credit, they'll easily give you. Okay, I hope it is clear. Now coming asset turnover ratio. So depending upon the different concepts of asset employed, there are many variants of these ratios. This ratio measures the efficiency of a firm in managing and utilizing its asset. Okay, so there are four or five types of turnover ratio. Let us see. The first one is total asset turnover ratio. It is simple, just we use the sales or the COGS, that is cost of goods sold, divided by average total asset. So we will to calculate the total asset turnover ratio, we will simply divide the sales or cost of goods sold by average total asset. Okay, now I hope you know what is the cost of goods sold. If you don't, then kindly reminded what is cost of goods sold. So coming up, fixed asset turnover ratio. So just like the previous one, simply we will use the previous formula and replace the total asset with fixed asset. So it comes up to sales or cost of goods sold divided by average fixed asset. Okay, and the next one is also similar like the previous two, and this formula is capital turnover ratio. So in this formula we will use the sales or cost of goods sold, and in the denominator we will use the average capital employed. Okay, and the last one is a working capital turnover ratio. So for this we are also using sales or cost of goods sold, and in the denominator we will use net working capital. So these four formulas are very easy to remember. In the numerator, in all those formula, we are using sales or cost of goods sold, sales or cost of goods sold, sales or cost of goods sold. But with the name of it in the ratio, it is changing in the denominator. Like the first one is total asset turnover ratio. So in the denominator, it comes up to average total asset. Okay. While on the second one is fixed asset turnover ratio. So for this, we are using average fixed asset. Okay, and the third one is capital turnover ratio. So for this we are using average capital employed. Okay, the last one is working capital turnover ratio. So for this we are using net working capital. Just remember one thing, net working capital, not the gross one. I hope you know what is net working capital: current asset minus current liability. So net working capital is equal to current asset minus current liability, CA minus CL. Okay, so I hope these formulas are clear to you. Just remember one thing, in the numerator we are using the sales or cost of goods sold, and in the denominator we will replace with their accordingly the name of this ratios. Okay, coming up, next slide please. So higher the ratio are indicative of efficient management and utilizing of resources, while the low ratios are indicating of underutilization of resources and presence of ideal capacity. Let's say in the total asset turnover ratio, if the ratio is too higher, or it is a higher ratio, then it shows that you are properly utilizing, or your resources, that means your total assets are properly utilized, and the company has performed the efficient management task. Okay, but if your ratio is lower, that means your asset or the resources are not properly utilized, though they are underutilized, and there is a presence of idle capacity. Okay, so higher the ratio, the better it is for the company, while the lower turnover ratios indicate that the company is not utilizing its resources properly. So underutilization of resources. Okay, so that is all for this particular part. The rest of the formulas we will discuss in the next part. So thanks for watching. Thank you. Bye bye.